Today, I'm delighted to be joined again by Ben Thompson, the Deputy CEO of Mortgage Advice Bureau. MAB is listed on AIM Market and is one of the leading intermediaries with over 2,000 nationwide advisors, and they handle something like £24 billion in loan annually. Ben, welcome to the Box Market Show.
No, hello, and thank you very much for having me on.
It's great to speak to you again. So tell me, how does the housing market? I mean, we're looking ahead now to 2025. It's the start of the new year. How's the market volatility looking? Is it going to impact MAB's share price? And how do you help investors focus on sort of the long-term view for MAB?
So I daren't say it, but I can't believe our share price isn't going to take more of a battering. But I won't tempt fate. But I do genuinely feel we've had a pretty rough time. Some of it I can understand, when it relates to interest rates or maybe maybe even the A market. There's lots of things I can look at and say, yeah, I kind of get it. But the reality was probably 3, 4 years ago, our share price was well over double where it currently is at the moment. And yet I think we're a significantly better business. So somewhere within that, I would have thought is a fairly strong comment. The market itself, I look into the year, and for me, always kind of expected mortgage rates to be a bit disappointing, inflation to be a bit sticky, and felt that at and around 4%, we got a healthy market. Five's a bit slower. So there's no surprises there for me. We'll have to wait and see where rates go. But one of the scenarios could be that the economy continues to be very weak, and actually we need to drop base rate quicker than expected. That's probably an optimistic one. But right now, what we can control is we think we've got mortgage rates at and around a level that our advisors can work very well with. Yes, it's not going to be a boom market. We don't need it to be either. Two points I make. One, advisors from a resilience point of view, they have to find business to write. A lot of people just assume, well, if a market drops 30%, your numbers go down 30, surely. It doesn't work that way for us. And one only has to look back at our numbers over the last 10 years to understand that, well, last year is a good example. Productivity went up quite a lot per advisor. And what we tend to find is they find business to write because they're really good at it, and they're actually very resilient. So the firms they work for and within, and that helps MAB come through the difficult times really well as well. So the final point being, use the word resilience again. At any given start of the year, this year being a great example, I can see that well over a third of our business will come through a refinance. So it's repeat business. Our client bank gets bigger every year, or our firm's client banks get bigger every year. They find more and more refi business to write, and they'll do a really good job of it. If the clients need protecting, they'll protect them. In that one comment, I've not talked about the housing market. And often we get scored down when the market's flat or soggy, or worse than that, when it goes down. The reality is we still typically grow market share, very typically, and we very typically grow our bottom line and top line numbers as well. So I do sometimes feel we're certainly underrated in that regard, and probably undervalued as well.
Okay. I know the last time we spoke, you were sort of very much sort of promoting the technology side, and I sort of used the term fintech, which you weren't pleased about. But I remember you saying you didn't like being labeled as such. But I mean,
Yeah.
why should we benchmark you as a technology as opposed to a traditional mortgage player then?
Yeah, and I think I definitely don't like the tag. It's a nice one, actually. It's just more, sometimes it's very difficult to categorize us as a business. We span a few different descriptions. I always say, in our own market, we're kind of known as a mortgage network, and we're a bit precious and don't really like that either, but it does explain us very well. On the other side, to your point, we kind of are a fintech. We're a platform business in its most generic sense. We're very technology driven, completely different than 5, 10 years ago. Constantly doing new stuff that we know many of our peers, if not any of them, are doing. And we're significantly becoming much more of a platform business that's capital light, throws off an awful lot of cash, and is scalable with all the advisors and appointed rep firms around the outside growing. And that technology theme is also, I believe, going to put us in a very strong position for the medium longer term, where we don't really know what's going to happen. You and I haven't yet talked about AI, and I feel very unqualified to talk about it, of course, but it is under my line. It's one of our focal points at the moment, and it's quietly exciting. But what I can look at, whether it's tech and or AI in isolation, are both of which are obviously the same, there is going to be a lot of change. And we need to make sure we're at the forefront of that change, not lagging, and that's very definitely what we're doing. And I think that puts us in a greater place for the future, because fundamentally where we want to get to as a group is we want to be the first place people go to when they want mortgage advice, customers, obviously. You don't go direct into a bank or a building society anymore. That's not a great experience for anybody. And we want to be the best in that intermediary pack, and that's absolutely what we're aiming to do.
So I guess what you're saying, if I was to put my stockbroker hat on and I'd be chatting to a client, say, I'd be clear explaining that, this isn't a mortgage provider, but you're a technology platform. And I think the market needs to start to think of you more as a tech platform. And there's no correlation, therefore, with the sort of market volatility that one would expect in the sort of property sector, let's say, for example.
Yeah, I think it's very fair, because without getting too numbers detailed, you'll be delighted to hear I can't do that, of course. But if I look at extreme market conditions, when the housing market's strong, we get a lot of higher margin business, because a first time buyer is slightly more profitable to us than refinance business. But refinance business banks far more quickly and you lose less of it. So by the time you put it all through the washing machine, if that makes sense, it doesn't make a huge amount of difference whether we're in a strong refinance market or a purchase market. And that typically gets lost. And again, the only way I can prove it is by having a look back at the numbers. And again, to my point from before, you'll see the resilience that comes through when you look back over, in particular, the last decade, where we've had, what, 3 black swan events at least. So, it's a big point.
So as a business, MAB has huge potential to scale, which is, I suppose, a major advantage of any tech platform. But as with all tech platforms, what's the cost per customer acquisition? I mean, is it expensive? And are you maintaining profit margins at that rate?
No, so I mean, from our point of view, the margins they've stayed remarkably similar over, well, certainly all the time I've been here, which is pretty much 7 years, and certainly the last decade. What we have seen, and I do believe we'll see, is being careful what I say, but from a margin point of view, talking generically, with the technology we're deploying, with the heavier focused on repeat business, with some of the ancillary products as well, I can foresee their efficiencies that will come through, and some of those KPIs will start to turn a lot more positive as well. So I think the areas to look out for with us in the medium to longer term is going to be things like gross profit and overheads ratio in particular. Again, as we become much more of a scalable business that's much more technology driven as well, with more efficient processes and governance as well. So I'm excited about what that means. And I would also say that 2 things. One, I say we continue to invest, so I can't repeat too much on that. But the key thing from our point of view is that technology efficiency will come through, and it will be recognised and noticed a lot more when the market goes back to a degree of normality. At the moment, those numbers are being hidden and masked by the fact that the market's still way beneath its long-term average, housing market now I'm talking about. Mm-hmm. When that gets back to a steady state, or even better than that, we even get a tailwind and better market conditions, then suddenly those numbers become a lot more pronounced.
But you mentioned governance there, which is a big topic in any financial industry. And I know from my own experience how difficult it can be managing those and, maintaining operational efficiencies when you've got all these regulatory changes going on and things you have to implement. Are you preparing for those? And do you see any of these changes that are coming negatively impacting the bottom line of the business?
Well, the first point I'll start with is regulation is if you view it right, or if one views it right, it should, when you get the customer outcomes right and you do things in the right way or for the right reasons, so the customer gets a great outcome every time, then you're probably most of the way there. And if we don't do that, we fail somewhere as a business anyway. So I welcome regulation. I think dealing with the numbers side to it, yes, it's becoming very expensive. I'm definitely not going to hide behind that point. It is very expensive. Aspects of it can be prohibitive, not just on our side, but on the lending side. I believe a lot of the very good that's done in, I think it's 2014, has probably kept quite a lot of people renting rather than owning a home. And that's, a challenge for lots of other people besides me. But, I welcome it, because also it's potentially it's a tailwind for those that do it well. Yes, we've got the scale to cope with it and invest in it and make sure we've got, well over 100 people in risk and compliance looking after customer outcomes. But the key for me is, unfortunately, I think the bigger people will find it easier. The small and medium-sized firms will find it harder. And of course, that potentially is a tailwind for us in terms of recruitment of new appointed rep firms into MAB. So I'm absolutely fine with it, with the caveats I've already mentioned.
Great. Well, Ben, it's always a pleasure talking to you, and I'm looking forward to speaking to you again soon. Thank you very much for your time.
Definitely. And thank you for having me on again, and all the best.
Cheers.